Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Polar Power.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just get straight into today's analysis. We are looking at a classic distressed turnaround play today.
Yeah, situated right at that really fascinating intersection of the industrial and defense sectors.
Exactly. And we are framing this entire conversation around a high-risk, high-reward setup. I mean, we are talking about a micro-cap company with a massive, just absolutely suffocating short interest.
Right, and let's set the expectations immediately for everyone tuning in. The core thesis we're unpacking today, it is not about finding a safe, long-term buy-and-hold investment, to just tuck away in your retirement account.
Definitely not. That is not what this is.
No, not at all. We are evaluating a very specific 1 to 4 week swing trade. It's an opportunity based almost entirely on the explosive market mechanics of a potential short squeeze.
Right.
However, and this is the crucial part that separates it from just a pure gamble, this setup is fundamentally anchored by some genuinely surprising cash flow discipline from the company's management.
Yeah, but before we even touch the wild price action or, the hype around that short squeeze, you really need to understand what Polar Power actually does.
Yeah, that context is key.
Right. And more importantly, we need to understand why they haven't simply gone bankrupt. So Polar Power specializes in DC power solutions. Specifically, they build hybrid and solar systems for what they call mission-critical environments.
Yeah.
We are talking about the core infrastructure of the telecommunications industry and the military.
And that mission-critical label is an incredibly important detail to pause on. When we use that term, we mean environments where a power failure isn't just a minor inconvenience, it's a catastrophic failure.
Right, exactly.
If a commercial telecom tower goes dark during a major storm, entire regions lose emergency communication. If a forward operating military base loses power, the operational consequences are severe. And because Polar Power designs these highly specialized proprietary hybrid and solar DC systems, their clients face incredibly high switching costs.
Let's unpack the mechanics of those switching costs, actually, because that's what creates a competitive moat. Once this proprietary infrastructure is integrated into a massive telecom network or a defense system, you don't just rip it out.
Right, you can't just replace it with a generic diesel generator from a hardware store on a whim.
Exactly. The technological integration is deep. The software communicates with the grid, the hardware is custom-fitted. Replacing it means downtime, and downtime is the one thing mission-critical clients cannot afford.
Which brings us to the harsh reality of their current financial situation, because the numbers in their recent filings are stark.
Oh, yeah, they're rough.
For the quarter ending September 30, 2025, they reported a staggering 74% decline in net sales.
Wow.
Yeah, that is a massive drop in top-line revenue, and it logically led to a $4 million net loss.
Yeah.
When you see a 74% decline in sales, your immediate instinct as an investor is usually to run for the hills.
It looks like a dying business on paper, for sure, but looking at the underlying data, it reveals a bit of a paradox. You have to look at the stabilization efforts that took place throughout 2024.
Right.
Their overall sales in 2024 dropped slightly by 6.7%. But despite that drop in revenue, their gross profit absolutely surged. It went up 89% to $1.3 million. I need to push you on this because it sounds impossible. How does a company actively shrink its sales yet see its gross profit nearly double?
It sounds like a complete contradiction, but here is how that happens mechanically. Gross profit isn't about how much you sell. It's about how much money you actually keep from what you sell.
Okay.
When sales start to collapse, a smart management team stops chasing expensive, low-margin new business just to make the top-line revenue look good.
Ah, I see.
Instead, they cut their bloated operating costs. They only fulfill their highest margin backlog orders. You effectively shrink the company, but the part that remains is highly efficient.
So they are cutting the fat.
Fiercely. And you see the mechanics of this survival strategy even more clearly in their cash flow management. Their operating cash use the money they're burning just to keep the lights on it drastically improved.
Yeah, plummeted, right.
Exactly.
Yeah.
It dropped from $3.4 million in 2023 down to just $536,000 in 2024. On top of that, they aggressively reduced their inventory by $3.5 million. They took parts sitting on warehouse shelves and turned them into cash to fund their operations.
Think of their balance sheet right now like an airplane losing altitude. The 74% drop in quarterly revenue means they essentially lost an engine.
Yeah, that's a good way to look at it.
But instead of just panicking and crashing, management started violently throwing heavy baggage out the door. They liquidated that $3.5 million in inventory and slashed their cash burn.
Right.
Now, to be clear, they are still losing altitude. They aren't climbing yet. But they've drastically slowed the descent, trying to glide just long enough to reach the runway. And in this case, the runway is their backlog of actual paying orders.
And we just saw a powerful validation that they might actually make it to that runway. In October 2025, they secured a $674,000 contract from a military customer.
Which is huge for them right now.
It's undeniable proof of life. It proves that despite the terrifying drop in overall sales volume, Polar Power remains a trusted vendor for defense applications where reliability is absolutely paramount.
Okay, so they stopped the bleeding, they built a fundamental floor of survival, and the company isn't going bankrupt today. But survival alone doesn't make a stock jump 60% in a single week.
No, it definitely doesn't.
That kind of violent upward price movement means someone in the market is getting caught off guard. Let's look at the technical fireworks.
Yeah, what we've seen recently is classic bottoming behavior characterized by intense, sudden volatility. On March 12, 2026, the stock suddenly surged 20%.
Wow.
And in doing so, it crossed its 200-day moving average for the first time since January.
Let's explain why that specific line matters. For you analyzing charts at home, think of the 200-day moving average as the ultimate lie detector test for a stock's long-term momentum.
Exactly.
When a battered stock finally breaks above it, it signals to algorithmic trading bots and technical day traders that a brutal long-term downtrend might officially be over. It acts like a flare gun going off in the dark.
And that flare gun certainly worked, because over the span of just 4 trading sessions, the stock gained over 60%.
That's incredible.
Now, at its current price of around 1.55, it is still sitting well below its 52-week high of 5.75. But that sudden recapture of the 200-day moving average suggests a massive, violent shift in momentum.
Which leads us to the metric that is driving everyone absolutely crazy on the trading boards right now. As of March 13, 2026, nearly 43% of the total available shares, what we call the float, is sold short.
Yeah, 43%.
That represents an 800% increase from the prior month. But I have to challenge the bullishness here.
Okay, go ahead.
If you are listening to this and trying to gauge actual market sentiment, think about what an 800% spike in short interest means. It means the smart money, the massive institutional short sellers, are incredibly confident this company is going to fail.
They are.
They are pouring money into betting against it. Why on earth are we treating a massive, coordinated institutional bet against the company as a positive catalyst for a swing trade?
That is the defining question of this entire setup, and it requires us to walk through the brutal mechanics of a short squeeze. You are absolutely right that short sellers are betting heavily on the company's demise. But you have to look at the scale of the battlefield.
Okay.
Polar Power's total market capitalization is only $4.12 million. It's a microscopic company in the public markets. Because of that, there are very few actual shares available to trade.
Right.
When short sellers borrow shares and sell them into the market, they're hoping the price drops so they can buy them back later for pennies and pocket the difference. But if the stock price goes up instead of down, their potential losses are theoretically infinite.
Because a stock can only go down to zero, but there's no ceiling on how high it can go.
Precisely. Now imagine you and a dozen other massive hedge funds are all trapped in a room betting the stock will crash. But because the market cap is so small and the short interest is so incredibly high at nearly 43%, there is only one tiny exit door.
Yeah.
This extreme bearish positioning actually sets a mechanical trap for the short sellers themselves.
A trap that gets sprung by the slightest bit of unexpected good news.
If Polar Power releases any positive news, like that new military contract, or better than expected earnings, the algorithmic bots see the momentum and start buying. The stock price starts to rise.
And the shorts panic.
Suddenly, those institutional short sellers are bleeding cash. To stop their infinite losses, they are forced to buy the stock back to close out their negative positions.
But remember, the float is tiny. There simply aren't enough shares to go around.
Exactly. When all those short sellers rush for that single tiny exit door at the exact same time, trying to buy shares that aren't available, it creates a tidal wave of forced buying pressure.
The price skyrockets.
Which forces even more short sellers to hit their pain threshold and buy, which pushes the price even higher. That chain reaction is a short squeeze.
This mechanical trap has created one of the most fascinating sentiment tug-of-wars between Wall Street and Main Street that we've seen in our recent research. This extreme short interest highlights a deep, almost philosophical divide in how different factions of the market view this company's future.
The divergence couldn't be starker. Wall Street, the institutional side, is incredibly bearish. The professional consensus is overwhelmingly a sell.
Yeah.
For instance, Weiss Ratings reiterated a sell rating on the stock in December 2025. But if you're trading the setup, that widespread institutional negativity is actually your greatest strategic asset.
Because it's priced in.
Exactly. That extreme bearishness is likely already fully priced into the current stock price. Because Wall Street expects absolutely nothing from them, it sets an incredibly low bar for success.
Meanwhile, retail investors on Main Street are looking at the exact same data and coming to a wildly different conclusion. They are extremely bullish.
Oh, very much so.
If you look at the message volume on stock boards on March 12, 2026, it just exploded. Retail traders are rallying around the stock, labeling it supremely undervalued. They are pointing straight at that recent military contract, looking at the cash flow discipline, and completely ignoring Wall Street's pessimism.
Yeah.
It reminds me of a polarizing movie release. You know, when a highly anticipated movie comes out and the professional critics give it a terrible score, like a 12% on Rotten Tomatoes, because they are analyzing the lighting techniques and the pacing of the second act.
Right.
But then you look at the audience score, and it's 99% because the fans just had an absolute blast watching it. Wall Street, our professional critics, can only see the recent 74% revenue drop, but the retail audience sees the military contract, the stabilized cash burn, and the potential to squeeze those institutional shorts.
That dynamic is incredibly powerful.
Yeah.
And that retail enthusiasm is currently being fueled by some very interesting speculative rumors floating around the community. Yeah. Now, to be clear, these are entirely unconfirmed rumors. But given the company's microscopic market cap of just $4 million, combined with their highly specialized proprietary DC power technology, there is growing chatter about a potential buyout or a strategic partnership.
I mean, the underlying logic makes sense. A larger defense contractor or a major industrial player could acquire them right now for absolute pennies on the dollar.
Exactly. They wouldn't even care about the recent revenue drop. They would just want to own that mission-critical hybrid power tech and integrate it into their massive global sales pipeline.
So if we piece this all together, we have a heavily shorted stock, intense retail hype, speculative buyout rumors, and a fundamental floor established by management throwing the baggage out of the airplane.
Yeah, that's the setup.
The obvious question if you're eyeing this setup is, what exactly triggers the explosion? What is the timeline? And conversely, what is the hidden landmine that could completely ruin this trade?
The primary catalyst, the match that could light this powder keg, is the expected March 30, 2026 earnings release. The market's expectations are incredibly low. Analysts are expecting $3.8 million in revenue and a 63-cent loss per share.
That goes back to the bar being essentially buried underground.
Because expectations are that dismal, any beat on that revenue number, or any management commentary confirming a new military backlog or new telecom orders, could instantly ignite that short squeeze.
It doesn't even have to be spectacular news, does it?
Not at all. It just has to be less bad than Wall Street predicted. A spark of unexpected resilience is all it takes to force those short sellers into panic buying.
There are also some massive macro tailwinds blowing in their favor right now. We are seeing rising energy costs globally alongside significant and very public grid instability.
Yeah, for sure.
Think about the massive rolling blackouts we've seen in major states over the last few years. When power grids are unstable, Polar Power's core business backup telecom infrastructure and hybrid solutions becomes highly relevant. Telecommunications companies are realizing they need guaranteed off-grid backup power more than ever.
But we have to talk about the bear case. We cannot outline a high-risk trade like this without shining a spotlight on what could destroy it. And the biggest risk here is liquidity.
Right. It's the sword hanging over the entire thesis.
Liquidity is extremely tight. As of their last reports, they only have $1.1 million in total liquidity, but they are carrying $5 million in net debt.
Yikes.
That is a highly precarious financial position for a company burning any amount of cash. If that upcoming March earnings report doesn't show a revenue rebound, if they somehow miss that incredibly low bar, the company might find itself backed into a corner with creditors. They might be forced into what is known as dilutive financing just to keep the lights on.
Let's explain why dilutive financing is the ultimate buzzkill for a short squeeze.
Yeah, please do.
The entire squeeze thesis relies on a tiny float, a small supply of shares. If management is forced to print millions of brand new shares and sell them into the market to raise cash, they just flooded the market with supply. They instantly devalue the shares currently held by retail investors, and more importantly, they just handed the short sellers a massive, cheap supply of shares to easily cover their positions. The squeeze dies instantly.
It's game over for the trade. Furthermore, you can't ignore the historical volatility. That 74% revenue drop from Q3 2025 proves unequivocally that customer demand in their specific sector remains highly unpredictable.
Yeah, that volatility is exactly why this specific profile results in a bullish score of exactly 6 out of 10.
It perfectly reinforces why we stated up front that this is strictly a 1 to 4 week swing trade. The strategy is to get in, wait for the earnings volatility and the potential squeeze, take your profits, and get out. It is absolutely not a set-it-and-forget-it investment.
Right. To summarize the core mechanics for you, Polar Power is a high-risk momentum play. It is relying on a massive 42.8% short interest creating a trap, a wave of retail enthusiasm acting as the pressure, and just enough improvement in their gross margins to keep the business afloat long enough for a catalyst to hit.
It's a calculated bet on market mechanics as much as it is on the company's engineering.
It's a fascinating setup of survival versus speculation. Before we wrap up our discussion today, I want to leave you with a final thought to mull over.
Right.
We talked about those global macro trends pointing toward increasing grid instability and rising energy costs. I want you to consider how physically vulnerable our large telecom networks actually are right now in the face of rolling blackouts or extreme weather events.
It's a real concern.
If grid instability becomes the new normal, could distressed, niche engineering firms like Polar Power suddenly transform? Could they go from being struggling microcaps fighting off short sellers to becoming urgent, vital acquisition targets for massive infrastructure giants who are absolutely desperate for plug-and-play backup power solutions?
It's definitely something to watch very closely as the broader energy and telecom landscape shifts in the coming years.
As always, remember to manage your risks strictly on these volatile swing trades. Thank you for listening to Smart Wealth with Joshua. We'll catch you next time.